Rethinking portfolios. The things that have worked for the last 40 years won't work in our new world of chaos. You need a different kind of portfolio, one with much greater diversification. Hello, GoldSilver family. Alan Hibbert here with another video, and today I want to present to you the case for investing in Bitcoin or gold or both. And this isn't just my idea. It actually comes from an article I found. So let's pull it up here. We've got Charlie Morris and Alexander Chartres. I don't know if that's how you say his name. They discuss the arguments for anti-fragile assets. So I want to go through a part of this article and use it as a springboard for looking at some charts, some data sets, and some other articles that might inform your thinking when you're developing your portfolio. So let's take a look here. These are 4 of the little paragraphs from the article I want to focus on, and we'll take a look at them one at a time. First of all, regime change. We've had 40 years of falling inflation, falling interest rates, low economic volatility, and crucially, peace. Okay, so let's actually look at these real quick before we go any further. So falling inflation, falling interest rates. Let's look at inflation. This here is the CPI year over year percentage change. And you can see that since 1980, since this peak in 1980, around 14.7% year over year, that's massive, 14% inflation. Since then, it's pretty much been dropping inflation. We've pretty much had low inflation ever since then. So that's what they're talking about. The exception being this recent peak where we hit about 9% year over year. That was June of 2022. So we have largely enjoyed low inflation measured as consumer prices. Also, they mentioned falling interest rates. Okay, so let's look at those very quickly. Here is the Fed funds rate. This is daily, and you can see that it peaked in December of 1980 at 22%. 22%. What a massive interest rate. And that was part of a long-term cycle of rising interest rates. And now we've had about 40 years or so of falling interest rates, and it seems like things are reversing. So yes, nowadays there is talk about getting a rate cut from the Fed, possibly later this year in 2024. But I believe that interest rates are going to be rising, generally speaking, for the next decade or 2 or 3 or 4. It's hard to say, but we are probably entering a period of rising interest rates. Okay, let's go back to their article here. So this pattern that's reversing, right? Okay, so this pattern has been manna from heaven for investors. It is also over. The next few decades will be full of inflation, volatility, and geopolitical unrest. That means you need anti-fragile assets. Okay, so I agree with this take here. It seems like everything is reversing. A 40-year trend, it's a pretty large trend. I mean, that's basically 2 generations. So we've had 2 generations of investors building their portfolio around a certain belief system about how the world works. Okay, that may have largely been true and that may have largely worked for 40 years, but it seems like things are shifting and a new mindset, a new approach to constructing your portfolio will be necessary. Moving right along here, rising debt levels. No one cares about structural deficits anymore. Does it matter? Yes, says Charlie, a lot. With debt at these levels and rising, you can't trust fiat money anymore. Okay, so let's look at debt quickly. We're looking here. So this is total public debt. In the United States, we're up over 34.5 trillion, closing in on 35 trillion. And you can see it's almost going straight up. I mean, it's funny, but it's not funny. It does seem like anyone who could do anything to slow this down has no interest in doing so. Okay, so we have rising debt. And if you can't trust fiat, you need to shift some of your wealth into non-fiat money. Why, yes, we do mean gold and maybe Bitcoin. So yeah, speaking of not trusting fiat money anymore, quick reminder, German kids flying a kite made of worthless money during hyperinflation, 1923. So yes, this was 100 years ago, but some basic financial truths don't change, right? Some basic economic principles will always exist, and you can't print your way to prosperity. So when you print too much, you get kids making kites out of money or currency. All right, so we do mean gold and maybe Bitcoin. So rethinking portfolios. The things that have worked for the last 40 years won't work in our new world of chaos. You need a different kind of portfolio, one with much greater diversification. And so in terms of greater diversification, what does that mean? Because typically diversification has meant something different than what it's probably going to mean going forward. I would say going forward, the form of diversification you want, and it's not just one, but it's really the difference between centralized assets and decentralized assets. So any stock of any company is necessarily centralized. That company could fail. The CEO could experience some kind of catastrophe. That company could be regulated. There's all kinds of centralized risk that comes with that. Whereas something like Bitcoin, which is not a company, can't really be regulated in its entirety. I mean, you might have to get 200 countries on board to try to coordinate the regulation. And, you know, there is no single company or CEO that would have to follow it. So even if you did regulate it in that sense, that wouldn't affect what it does. That wouldn't affect its monetary supply. That wouldn't affect how it operates. It would only affect whether or not people want to use it. So it's a very different kind of risk. Let's take a look here. Reserves. Gold has a new major class of buyer and central banks topping up their reserves. I do want to look at central banks topping up their reserves. We've seen since 2018, it's been the last 6 years or so, that central banks have been buying gold. And we have here a record percentage of central bankers expecting gold holdings to increase.
Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video.
Gold holdings to increase. So this is forward looking, right? So we're not looking back at the last 6 years of a new trend. We're actually looking forward here, and a record percentage of central bankers are expecting gold holdings to increase. So yes, we do have a big buyer on the streets, central banks. And of course, that is going to be bullish for the price of gold. And going back here, what does this mean? What does this mean for regular investors? How can we profit from it? ETFs or miners? Question mark. Well, maybe. Let's look at these two and see if these are good sources of profit. First, I actually want to focus on the miners. I want to share with you guys a chart that you probably have seen before, either on this channel or in Mike's latest book. This here is the price of gold in gold and the price of the Barron's Gold Mining Index in blue. And they're indexed to August 13th, 1971, right before Nixon severed the convertibility of the dollar to gold. And what you can see here is even though that they started at the same level, they've separated, and the gap between them has progressively widened all the way until 2021, 2022. And if this chart continued, it would continue to get even wider to this day. And this chart is logarithmic. So this gap here, if you just look at the distance, it doesn't look that big necessarily. But when you realize that the scale here is a factor of 10 between these lines, you realize that gold has outperformed mining stocks by almost one full order of magnitude. This here is a difference. If you divide 3933 by 460, that's about 8.5. So gold has done 8.5 times better, not 8.5%, 8.5 times. So 850%. So it doesn't seem like miners are something you would want to hold for the long term, right? Not 50 years or something like that. In the short term, sure, that might make sense. I mean, of course it would for some people. You either have to have inside knowledge or a lot of skill or a lot of luck or some combination of the three. But for the average investor who doesn't have a distinct advantage and who's investing over the long term, it doesn't really make sense to hold miners, or at least the data would suggest that. Going back, what about ETFs? Can you profit using ETFs? Well, what we just talked about a second ago with diversification and the idea of centralized versus decentralized risk, if you're holding an ETF, you're exposing yourself to more centralized risks. You're not really solving the problem. And I'll give you one example. The tweet came up just a couple of weeks ago. Europeans can now only place sell orders on Sprott physical gold and silver funds. There's a link to an article here I want to highlight. WTF, Europeans can now only place sell orders on Sprott physical gold and silver funds. So no more buying. So what is going on here? This is what happens when the elites are on the wrong side of the trade, heavily short gold and silver while those markets have traded against them. They simply change the rules. So again, another example of that centralized risk. So June 1st, just a couple of weeks ago, the information below was sent to King World News by one of our global readers from Norway, who has traded Sprott's 100% physically backed gold and silver for many years. He can now only place sell orders for Sprott's PSLV and PHYS gold and silver funds. Okay, only sell orders. Apparently, European investors can still buy GLD and SLV, which is suspicious because those funds are not trusted by many investors, including institutional investors who believe GLD and SLV don't hold the physical gold and silver they claim to possess and have nowhere near the transparency of the Sprott physical gold and silver funds. Okay, so in regard to GLD and SLV, again, centralized risk. Okay, so whether or not you think they have the metal, the physical metal backing the paper, you know, that's your decision. But the point is there is a centralized risk there. And so centralized governments can just change the rules on what you're allowed to do with these ETFs, whether you're allowed to buy, sell, both, or neither. And yeah, it's a form of centralized risk. So if you're holding ETFs, you're not necessarily diversifying in that way we just talked about. So here's part of the email. I'm not going to read the whole thing. No longer possible to buy any US or Canadian closed-end funds in the EU or EEC. This is nuts. Here's a screenshot, which he translates. Your order was not placed. Due to current EU regulations, it is not possible to invest in this security. Only sell orders are possible. This applies to all US and Canadian closed-end funds. Okay, so there you go. So going back to what we just looked at, ETFs and miners maybe aren't really solving the problem. There are three things I would highlight here. No pun intended. Number one, you need anti-fragile assets. I would agree with that. And anti-fragile, if you're not familiar with that term, something that's anti-fragile gets stronger when you stress it. So yeah, when you stress something, it gets stronger over time. People are anti-fragile, whereas something like a glass or a piece of ceramic is fragile, right? And sometimes companies are anti-fragile, sometimes they're not. Sometimes civilizations are fragile, sometimes they're anti-fragile. Depends on a lot of factors. Number two, you need to shift some of your wealth into non-fiat money, despite the fact that that's almost an oxymoron, or it's almost redundant, rather. Yeah, it's almost redundant. So non-fiat is money. Well, sort of. Anyways, but I would agree with that. You need to shift some of your wealth into non-fiat money. Gold, maybe Bitcoin. Of course, I would include silver in this. And number three, you need a different kind of portfolio, one with much greater diversification. So yes, not just greater diversification, but a new kind of diversification that often or historically hasn't been thought about. For the last 40 years, there was so much trust in centralized institutions, whether it's government or companies or currencies in general, that you almost didn't need to diversify against them. We're entering a period now where trust is at an all-time low, and holding decentralized assets seems very prudent, almost a necessity. So I want to leave you guys with one thing: a giant Bitcoin logo projected on the European Central Bank. Look at that. Study Bitcoin, study decentralized assets, study gold and silver. Thank you guys for watching, and I'll see you in the next video.